Excited to have this conversation, Yann, because obviously the narrative keeps changing. We're in volatile times. Just a couple of weeks ago, we weren't sure if we were about to head into all-out war between Israel and Iran. Has that particular risk receded dramatically in S&P's eyes now?
Not really, Vonnie, and thank you very much for having me. Geopolitical risk, has been something that was not really on anyone's radar up until, Russia invaded Ukraine. But now, from our perspective, and we hold our Credit Conditions Committee every quarter, after, the attack from Iran on Hamas, we actually said that this is the #1 risk for both macroeconomic and credit conditions over the world, and particularly in this region. At this moment in time, the big downside would be an escalation of the conflict. In this particular region, in the Middle East, in our sovereign ratings for most of the governments, there's a certain element of regional geopolitical risk that is baked in, but certainly not an escalation of what is currently the situation. So like every other market participants, we are really watching this very closely. The central scenario is that there won't be any escalation, but again, significant downside.
You downgraded Israel's rating just a couple of weeks ago to A+ with an outlook negative. What would it take for you to reverse that decision, or is that Israel's credit rating now for some time?
I think we need to get away from just the Israel situation. As I said, it's the entire region that could be impacted. At this point in time, obviously, Israel is directly impacted in its economy by what is going on. For the other countries, that is less of a risk. But again, if there were to be an escalation or, a block of the Strait of Hormuz, then, the consequences in terms of hike in oil prices could be positive for some of the economies, but then in terms of their ability to get, that oil onto the end customers would be extremely complicated.
What are the other challenges facing the global economy? Because obviously if there is an escalation, on some front, whether it's in Ukraine, Russia, or in the Middle East, you'll have to rethink your whole credit ratings, right? But other than that, what are the other problems that you're facing around the world when it comes to individual economies?
So actually, when you look at what happened over the past 3 years, and particularly when it comes to the US economy, it's been surprising on the positive side, and that's exactly what we're talking about at the moment. Will there be an interest rate cut? Probably not next June, as our US chief economist thought up until a couple of weeks ago, but probably from September. How many of those interest rate cuts? It's all down to, the fact that the US economy has been in rude health. So coming back to major downside risks, we go back to basically traditional credit risks. Higher for longer. If interest rates stay at this level, any weaker borrower that particularly is borrowing on not on fixed rate but on floating rates is going to be impacted. And the second major risk would be basically a hard landing, particularly of the US economy or some other economies, because the US economy has been supporting the rest of the world economy, particularly in the Gulf Cooperation Council.
What about real estate? Because even in the United States, where the economy is strong and defying all expectations on many fronts, real estate is a little bit of a problem.
It is on the list, but a bit further down, because at the moment it seems to be pretty much under control. But you're right, commercial real estate in the US is still something where some of the regional banks are keeping some significant exposure. But the biggest case in point is China. China is the second, engine of growth for the global economy, and the ability of the Chinese authorities to keep, that situation under control will be critical. China is now growing at half the rate what it used to be, down to 4.6% this year, probably, from Asia chief economist. That's a significant slowdown, and that situation is going to drag along. We don't think that is going to create, any crisis, but it's going to weigh on the ability of the Chinese economy and other Asian economies that depend on China for their export. That's going to weigh in and slow things down.
So it sounds like you're very much expecting a divergence among economies, particularly until the Fed starts to cut rates, right, which then might take a little bit of pressure off some of the emerging markets in particular. Which emerging markets are you mostly keeping an eye on?
So in terms of the positive side, another country that we haven't mentioned so far that is really raising its head is India, where we actually upgraded our growth forecast to about 7.6% for this year. And under any scenario, the Indian economy is going to grow around about that rate for the next 10 years. So that means that the Indian economy is becoming, a major player that has to be, reckoned with, and on the positive side. More on the negative side, I'd say that in general, it's not a question of established markets or between established markets or developing markets. You've got some, lots of fiscally strained situations on some of those government balance sheets, whereas, because of COVID and various subsidies, there's been a lot of debt that's been raised. And some of the sovereigns around the world, both, developed and developing, have got some fiscal rigor to reestablish. So that's something that we will be watching very closely.